Good morning, everyone. Welcome to Financial Management. This is week 2 with yours truly, Stephen Hilborn. So last week we introduced the income statement and we went through some basics about how to develop an income statement and look at the percentages of different departments. Today we're going to just kind of wrap up that whole thing, look at balance sheets a little bit, and then we'll also get into another activity about inventory valuations. Before I do so, I have a riddle for you. And when we meet in class next week, I want to see what your answer will be. So here's the riddle. A lady walks into a grocery store and steals $100 from the cash register. She leaves the store unseen and unnoticed. Several hours later, that same lady comes back and she buys $70 worth of groceries. She pays with the $100 bill that she stole and receives $30 back in change. How much did the store owner lose? Okay, so there's a bunch of different options there for you. Please take a look and let me know what your answer is during the next class. So yes, as I said, we'll review last week in the balance sheet activity, and then we'll get into some different inventory valuations as well as a balance sheet activity. So as we talked about last week, we looked at the 4 different financial statements and how they work with each other. The balance sheet being that snapshot of a particular time and how you're doing as a business. The income statement or P&L statement, which basically shows your operations and how you are actually doing in your business. The statement of retained earnings or the statement of changes in equity. And again, that is how the income statement and how the operational component of your business has affected your balance sheet. This is the change between the two, and this shows that. And then the cash flow statement, which we will look at on a later class. The balance sheet, so this was the example that was shown last week, and we discussed assets and the difference between current and non-current. And essentially, current assets are things that we expect to use up within one fiscal year. Same thing with liabilities. There are current and non-current, and then there are liabilities that have portions of both. The current liabilities are ones that we expect to pay off within 1 year, and the non-current are anything beyond 1 year. And we did talk about how a car loan, as an example, if it's a 5-year car loan, the current liability portion will be the first year, and then the non-current will be the following 4 years. Another thing that we need to know about balance sheets, that's a bad spot for my camera, about balance sheets, I don't know where to put this, is that balance sheets must, believe it or not, balance. So you will see here that our total assets, which equal $265,000, are equal to our liabilities and equity, which is $265,000. Counting 101. Again, you'll see this. Sorry about moving the camera. Again, this is another balance sheet, and it's a little bit different view where it's just side by side. All of the current assets and long-term assets, which bring you to a total of $405,000. As well as all the current liabilities, long-term liabilities, and equity as well. Again, $405,000. So this is showing that this balance sheet is in fact balanced and is a proper view of what a balance sheet should look like at any particular time. We also looked at basic income statements, which we reviewed and you have done an assignment for. And the basic formula would be revenue minus cost of sales equals gross profit. Then we subtract other costs or any administrative costs, which is profit before tax. And then we subtract any income tax or depreciation and all of those kind of government instituted costs. And then that gives us our net profit or our net loss. This is an income statement in a hotel. So it's a little bit different because hotels have multiple revenue streams. Again, we did look at that already. So rooms, food, beverage, spa. They could have rental programs. It could be a ski hill. So they have the rentals for the skis as well as the chairlifts. So what we like to do with those kind of places is that it will show the individual department revenue as a percentage of total revenue, okay? But it'll show departmental expenses as a percentage of that individual department's expenses. So in your first assignment, I asked for everything to be all as a percentage of total revenue. Now, and we can do that, and that's fine. But when it comes to costs or expenses, what we want to see is that as a department, how did it do? So as an example here, you're looking at rooms. Their costs were $3,950. Their rooms revenue that they brought in was $15,193. And essentially this is showing that their cost was 26%. So $4,000-ish is 26% of the room revenue. Food and beverage, $7,000. Their cost is 78% of the food department. Telephone is 63% of the telephone revenue, and so on and so on. And that gives us an actual kind of analysis of individual departments and how they're operating as just that department, not as the greater whole. So this is a portion of a horizontal income statement. So you can see how it's easier to see the related expenses and how they affect each department. So the term contributory income is the amount each department contributes to total revenue. So you can see there's each of those individual areas: dining, banquet, beverage, and then we have a total. The dining room brings in the most sales, as you can see, with $202,000, much more than banquet and beverage. But the dining area also has quite larger amount of the cost. So $81,000 for cost of sales, $65,000 almost for wages and salaries. So as a whole, they bring in about $37,000 for the entire business. And if you look at banquet and beverage, you can see that beverage brings in almost $50,000, and they only make $90,000. So it's over 50% of their revenue they're maintaining, while in the dining area and the banquet area, not as much. And then departmental expenses are considered direct expenses, which means they are taken right away from the revenue. So that's the cost of their sales. It's direct. Like, you need to have those expenses in order to make that revenue. So some of those examples would be food and beverage, salaries and wages, other payroll costs, linen and laundry for any accommodation, any of the spa expenses. This is the rest of that vertical income statement. So we will look at all the different areas, and then we'd start removing. Let me move this camera somewhere else. That's a weird spot. There we go. And then we start removing all of the other. So the direct expenses we can remove from each different department, but then we total all of the departments together and remove these kind of big umbrella-like costs where you can't really say that they belong to one department over the other. Rather, they just belong to the entire business. So you subtract all of these. So in this particular example, it's leaving you with just about $400,000. Then we have our fixed charges. So fixed charges can be property tax. It could be insurance. So it's something that we have to insure the entire property and our workers. This is like a government mandated by law. You need to have this. Same with property tax. We need to pay tax. Interest, we need to pay interest on any of our loans that we might have. And then depreciation, which is, if you remember, depreciation is essentially the value of property or value of assets going down over time. So you buy brand new beds and mattresses for your hotel, but 365 days later, all of those beds have been slept in numerous times. All of those mattresses have been slept on numerous times, and who knows what happened to them. They are not worth the same amount of money. So we must remove the value from them. So this comes, our total fixed charges are $239,000, which leaves us with $94,000. And then we get taxed on top of everything. So this is just your income tax. Same thing that you pay on your paychecks, you pay tax. It's why we have parks and hospitals and roadways and all the other wonderful things that we take advantage of. So in a 50% tax bracket, they are left with $47,400. So they made $50,000 only by the end of the year. Indirect expenses are ones that are not directly related to the revenue producing activities, like I said before, and this will give you an idea of what some of these are, as well as the fixed charges, which we looked at a few, but it could be these plus maybe some other examples. This is the rest of a horizontal income statement showing each indirect cost and how they would apply to each department. This format allows management to see how each department is doing. So the difficult part here, so you see all of the very similar security, franchise, marketing, all of these things. Typically, most businesses group them together and take them away as a whole. This one here, they're looking at and say, we're going to split it up amongst departments. It is hard to split these costs up. There are several ways to do it, and on week 3, we'll look at each individual way. Often it can be, we will split up the departments by square footage. So my rooms department obviously takes up the most space because I have 100 hotel rooms and they take up much more than my restaurant. So we could break it up by square footage, or we could break it up by sales percentage, which means my rooms, I bring in 80% of the revenue for the entire property from my rooms revenue. Therefore, it should get 80% of all of these costs. So that's another way to look at it. This is material that we'll really get into on week 3. Basically, it's a contributory income statement, and it's looking at how do we divide in a somewhat fair fashion all of the costs amongst many different revenue centers. Rooms, food, beverage, rentals, golf course, whatever our resort or our hotel makes money on. And this is a very helpful thing where it just kind of gives you the formula of how we break it down and how we get to net income or net profit. So we start with our department revenues, subtracting our direct costs, and this gives us our contributory income. So what does each department deliver, or what does each department give to the company as a whole? This is very controllable by management because your direct costs are your food costs, your beverage costs, your labor costs, your expenses, your materials that you might need. Next is we subtract our undistributed expenses. So these are indirect costs, as we looked at. So some of these, like franchise fee, not very controllable. Utilities, maybe very controllable as far as how often we launder our sheets. Some hotels put in low flush toilets and low, like low pressure faucets and shower heads. That is one way that you can control that. So some of these things are controllable by management, others not so much. When you take your contributory income and subtract that, you are left with your gross operating income. So thinking about this, we have subtracted all of the operating expenses, our direct and our indirect costs. We still need human resources and marketing and property maintenance to operate our business. Next, we subtract our fixed charges. So these are indirect costs again, but these are fixed, such as tax, interest, insurance, depreciation. And then that leaves us with our income before income tax. And like every person in the world and every company in the world, you pay income tax. You are probably in a lower tax bracket, so you might pay 12 or 15 or 20%. And as you make more money, you go higher and you pay up to 51%. I think if you make like $300,000 or $400,000 a year, you pay up to 51% of your income. And that's on a personal level. As a corporate business, you pay less because the government charges you less, but it's still a really big chunk. So we subtract the income tax and you are left over with whatever is remaining. And we have very little control over that stuff. So I'm going to get into the inventory valuation, but this is a fantastic time if you need to take a quick break, go get a coffee, go to the washroom, pause this video, and come on back. Welcome back. So next thing that we want to look at is how do we value inventory? So food and beverage is a big one as far as what kind of business we really think about inventory, but also retail, and has a lot to do with accommodations as well. So this could be how many sets of sheets, towels, shampoo, like we have so many things that we place in a room. So that has a value to it. So we always have to show how much are we using, because that's a cost. And then also, that's on an income statement, but then also on a balance sheet, if they want to know how much we're worth, we might have $50,000, $100,000, $500,000 worth of inventory. And this could be wine, it could be alcohol, it could be food, you name it. That has a value to it. So there's different ways of valuing these different inventories. So the following are the purchase dates for our house red wine in which we sell the most often. So you see that this right here, they have 4 different transaction dates. The 1st, the 5th, the 14th, and the 26th. And on those dates, they purchase a bunch of different amounts. So let's say they're bottles. So 5 bottles, 3 bottles, 6 bottles, and 3. In total, they have purchased 17 bottles. Because prices do fluctuate, on all of these days, they have paid a different amount of money. So our total cost of units is $125 for this, $81 for this purchase, $144 for this purchase, $87 for this one. Anyways, we have spent $437 in the month of December purchasing this specific red wine. Now, automatically you might say, I know how to value inventory. You just did it. You have 17 bottles. They cost you $437. That's how you value it. Yes, correct. But the problem is we can't go through and write down every single item that we've ever purchased in the month of December and do all the math and then subtract all the times that we've sold it. It gets very time consuming and it's just not worth it. So we need to come up with different ways to easily value our inventory. We're going to look at 4. So the specific unit valuation method, or the actual price method, is where we charge based on what individual unit cost. That's what we were just looking at. It's labor intensive. It is not used in the industry hardly ever. And it would be charging a different price every time a customer orders a meal because the ingredients have changed. So every time someone comes in and orders a pound of chicken wings, you would have to look back and say, okay, well, the last time we bought them, it cost us $8, but now this time, tomorrow it might cost us $9. So you would have to change the prices all the time. It doesn't work that way. So that is one way, but we usually just throw it out. It takes too much time. So the next way is the weighted average valuation method. So this is the average. We're going to take all the bottles that we bought in December, the full amount of money that it cost us, and find out on average what did we spend for that. So when we looked at this, we said, okay, there's our 4 transaction dates, how much money we've spent, and the total. 17 bottles cost us $437. So this is one of the easier ways of doing it. We would just take the $437 divided by 17 bottles, and on average, we spent $27.06 per bottle. With this information, now I know how much I can charge the guest. So if I want to charge the guest twice the amount, then I know every bottle is going to cost them $54.12 if you're doing that. $54, and then I'll just charge that regardless if I bought it for $24 or I bought it for $29. The next one is FIFO, so first in, first out. So it allows the oldest goods to be sold before newer costs. So this is good, especially in industries with perishable goods, so things that only last so long. So we always like to say we use FIFO in restaurants because I want to sell the lettuce or the apples or whatever my produce or meat that I've purchased, the oldest one first, right? So if I purchase something on Tuesday and I purchase something on Thursday, on Friday, I want to make sure I'm selling Tuesday's produce because that will go bad quickly. So if I don't sell it within 3 or 4 days, usually it will be waste and it'll go in the garbage, and that's a high cost for us. So it's one of the easiest methods for the industry, and it helps reduce waste. So it's kind of has 2 great reasons for it. So here is how you would do this. So on December 31st, the Wine Emporium had a closing inventory of 8 bottles of their house wine. What is the total value of inventory and the average per bottle? So now we have to do a little bit more thinking about this. We got to think about when we purchased it and when people ordered it. So first in, first out. So we know that the last 8 bottles remaining are the latest bottles purchased. So the ones that we have purchased on the later dates, because first in, first out. So we need to determine the cost of the last 8 bottles. So what I would do is I'd work backwards from the end of the month. So I'm looking to say, when is the last 8 bottles that we purchased? Well, on December 26th, we purchased 3 of them. So, okay, well, that's 3 of my 8 bottles I purchased. We spent $29. So I'll just say December 26th, we had 3 bottles at $29. That equals 87. Perfect. The next one, I'm going to look to the next date, December 14th. We purchased 6 bottles. Okay, well, we don't need 6. We need 8 total. So we already have our 3, so only 5 of these bottles are we going to need. So 5 bottles at $24 is $120. Our total is 8 bottles that equal 207. So we'll do a little bit of math per bottle. So our inventory remaining is 207. Our per bottle cost is $25.88. So that's first in, first out. We like to do this with more expensive items because it does matter what the cost would be. And then we have another one, which is probably the most common used valuation method, which is the latest purchase price. So what we do is that we look at the ending inventory. Let's say we have 8 left. And now we just need to use the latest purchase price, which is $29. So 8 bottles times $29 is $232, and per bottle, $29. The reason that we do this is quite simple. When you think about buying these items, you say, the latest purchase price is what I can reasonably expect to pay if I need more. So if yesterday I spent $29 on it, and I have to go buy some more today, I would probably assume it would cost me $29. Unless, and it could be wrong, but that's a very reasonable thing to assume. So latest purchase price, it's the easiest, it's the most cost efficient, and just really, it makes, as far as labor costs and having someone go through every single item and determining what the costs are, just saves you a lot of money there. So we looked at 3 different ways that we want. The first one we threw out, we looked at weighted average price, first in, first out, and latest. So we came up with 3 different averages for those bottles depending on it. It was $27.06, $25.88, and $29. So you can notice a difference. Depending on what you choose, you might have different numbers. These can vary if there are huge cost fluctuations. I remember there was a few years ago where the Mexican cartel or mafia or whatever it might have been took over a lot of lime plantations in Mexico. And limes that used to be about 30 cents per lime were now like $2 a lime, which is a 5 times cost or more. 6.3% more, actually, 6.3 times more. So when you think about something like that, if something costs that much more, these valuations kind of are thrown out. Beef has also been the same. We had mad cow disease a few years back in Alberta. Beef costs went through the roof because now we had to import all of our beef. These are things that happen. So just, you got to keep an eye on it. So this is an exercise here where we say, determine the ending inventory value of 12 units using the 3 methods listed. So this is our in-class exercise that I'll go through. So we're going to use all 3, weighted average, FIFO, and latest purchase price. So we're going to do weighted average together. So you would go through and do all of the math. 9 times 4, 12 times 4.5, 5 times 5.25, 8 times $4.30. You can come up with your totals and determine that you spent $150.65 and you purchased 34 units of, what are we even buying here? Doesn't say, of food. So 34 units by $150. So basically what we do there, if we are doing weighted average, is that we take $150 divided by the 34 items, and we get an average of $4.43 per item. And if we have 12 remaining, we take that $4.43, multiply by how many we have left on our shelf, and we come up with a $53.16 ending inventory value. Perfect. Next one is first in, first out. So we know that we have 12 bottles remaining. So again, we're going to work backwards. We're going to take the last 8, because first in, first out means that whatever we purchase first will be the first one sold. So all these 9 will be sold, these 12 will be sold, and one of these 5 will be sold, leaving us with 12 remaining. So let's start working our way backwards. The 8 on December 26th at $4.30 is $34.40. 4 of these 5 at $5.25 is $21, $55.40. Ending inventory of 12 cans has a worth of $55.40. And then the latest purchase price, again, the one that we use most often and the easiest, we would just say if you have 12 left, what was the last price that we purchased it at? Well, that was $4.30. We have a $51.60 ending inventory value. Again, take a look at it. Depending on what we have chosen for inventory valuation, we have a variance of almost $4 between one and another. It doesn't matter what you have chosen on how to evaluate your inventory worth, but it does matter that you stay with the same system. So if I'm going to use weighted average for everything, I have to make sure I use weighted average for everything, not when it just makes it look like it's worth more. So typically people say the latest purchase price, and it does not matter if the price has gone down $20. The latest purchase price is what do they typically use. And as long as they use that every single week or month or year, it'll be fine. So how do we value inventory using these methods as product is bought and sold, not ending inventory? So this will show you an inventory record card for a Caymus Zinfandel in 1996. So this is a nice, expensive wine. So it gives you 4 or 5 different dates here. So what we have to do now is determine how we purchase it, how we sell it, and what we have left over. And this will be our in-class assessment. So if you look to the practice assignment that's located under your weekly learning, attached in I think the same item as this particular lecture in PowerPoint, please look it up and attempt it on your own. Otherwise, I will meet you in class on next Monday or Wednesday, and we'll go over this together. Thanks so much for tuning in. 27 minutes and 55 thrilling seconds of financial management. Talk to you soon.